So in this video, we'll be discussing about financial management and objectives. So this is the first chapter that you have to undergo, and this chapter will be discussing about a wide area about what is financial management and how it is useful for a financial manager, and what is the usefulness of knowing these concepts. Okay, so once you know the basics of what is financial management, it helps you to understand the other subsequent chapters much more easily and also in a contextual framework. So these are the areas that we are going to look at. So we'll be looking at what is financial management, what is financial management decisions, what is financial planning, what is the relationship between strategy and the financial objectives, what are the financial objectives, and what are the agency concept. So these are the things that we look at in this chapter. So we'll start from what is financial management. So financial management is it's a management of finances of a company in order to achieve the financial objectives of the organizations. So it is like effective utilization of financial resources. Okay. So what is the objective of the company? See, the objective of a company is to maximize shareholders' wealth. Okay. So all the steps that is taken towards maximizing the shareholders' wealth comes under financial management. So this is a very important area. There are three things which are interconnected. So one is investments of a company, two is the dividends issued by the company, and three is financing of the company. Okay, so these three things are very interdependent upon each other. We'll see in real world how these are related. First, we look at what are the various sub elements within each of these topics. So under investment, it considers about all the capital investment such as the purchase of a machinery, the construction of a factory, the working capital needs of a company, any merger or acquisition of another company. So these are things which are coming under investment of a financial management. So the next one is the dividend decision. The company usually makes a profit and that goes to the retained earnings. So should the company give dividends? If they give dividends, it will reduce the retained earnings. Or the company can also issue debt and then issue dividend. If they do that, that will actually increase the interest of the company. So that might reduce the future dividend of the company. If the company is going to issue equity shares, and with that money they are going to issue dividend, means what happens in the future, the total number of shares have gone up, so the company has to issue more amount of dividend. Okay, or what would happen is all the shareholders would receive a lesser amount of dividend. Okay, so the company has to make an appropriate decision whether they are going to use retained earnings, or they are going to issue debt, or they're going to issue equity share, and they're going to give a dividend. So usually dividends are given only from profits or retained earnings. And the last part of the financial management decision is financing. So the company has a lot of source of finances. So they can raise money through debt, through equity shares, through retained earnings. Okay, so these are the various sources. Within each of these categories, there are still subcategories which are available. So if a company issues too much of equity shares, then it reduces the existing owners' proportional ownership. If the company issues too much of debt, that will increase the company's financial risk. So the company has to take an appropriate decision of which capital to use, because any capital usually comes with advantages and disadvantages. So we'll have a quiz now. Which of the following is least likely to fall within financial management? So which one do you think doesn't come under financial management? I think you can go through this question. So I'll read the options. The dividend payment. So dividend is a part of the dividend of the company. Funds raised to finance an investment. So raising finance and an investment, that comes under financial decisions and investment decisions. Surplus assets are sold off. So again, that considers about the reducing the investment and raising money. So that again considers financial element. So the only thing D is spending on CSR activities. CSR is corporate social responsibilities, and CSR doesn't have much linkage with financial management. So the answer should be D. So which is least likely to be a part of financial management is CSR activities. So we'll move on. We'll have a practical example of how the finance, investment, and dividend decisions are interlinked. We'll look at two companies. One is a really good company and the other one is a really bad company. So we'll see like how these three financial management elements are like playing within these companies. So we'll start from a good company. It's called as Pidilite Industries, or in a term which we really know well, it's called as Fevicol. This is the company which creates Fevicol. Okay, so we look at their P&L. This is their P&L for the last 10 years. Okay, so we'll focus on just a few key numbers. Look at the sales. Are they increasing or decreasing? They are increasing. Okay, by how many times they are increasing? So 1700 to 7000, that's something like 5 times. I think 5x, we'll put it as 5x. Sales is going by 5x. Look at their operating profit. Is it going by 5 times? Yes, most likely it's going up by 5 times. So operating profit is up by 5 times. Look at the dividend payout ratio. As the company is making a good amount of profit, they are able to declare dividend. The dividend is like averaging about 30%. Okay, so every year they are also giving good dividends. We will look at their balance sheet. So in balance sheet, we'll look at two things: the reserve. We'll check whether the reserves are going up. You can see that the reserves have gone around 8 times. It's 8x times of reserve. Okay, we look at their liability. Are the companies borrowing anything? It's 526. It's actually gone down, so that's again really good. So their reserves are good, their borrowings are very good. Okay, they're reducing their borrowings. First one is finance, second one is investment, and the last one is dividend. Okay, so finance, they are using equity a lot and debt less. That's really good. The company is making we'll check whether their company is making a good amount of investment. We'll check with fixed assets. Fixed asset has been 497 and it has increased to 1448. That means they are building more factories and more machinery they are buying. So their investment is also good. It also reflects in their profit. Their profit is also increasing. The company is also averagingly giving 30% dividends. So that is also good. Okay, and the reserves have also gone up. It means this company is having a really good financial management. Okay, that's what we can understand. So we'll look at the share price of this company. The share price of the company, look, in 2006 it was around 21 rupees. Okay, this company's share price today is around 1200 rupees. So 21 rupees has gone to 1200 rupees. So how many times it has gone up? It has gone by 60 times. Okay, so if you have invested 1 rupee here, you would have got 60 rupees here. If you have invested 1 lakh here, you would have got 60 lakhs here. Okay, so that's how good companies do. Okay, they perform really well, and that too over a long period of time. So we'll look at a bad company. So this is a very bad company here. Okay, Jet Airways. So we'll see their P&L. We'll look at certain numbers. We look at their sales. Is the sales growing? Yes. How much times? So sales is growing by 3 times from 7,000 to 23,000. We look at their operating profit. Their operating profit has grown from 263 to 24. Okay, it has, look at their price. It's gone down, it's gone down, it's gone way down, it's gone up, again up, down. Okay, this is like up, this is down, this is again down. Okay, it's up, it's up, it's down. Okay, see, this is not a very good kind of a business to be in. We can't say that they're a bad company, but this is not a good business to be in. Okay, even though the sales have gone up by 3 times, their profit has been so volatile. It is going up and down every year. Okay, with this kind of income, they can't promise a proper kind of a dividend. Look at their dividend, it's just zero, all the way zero. Why? Because they're not sure whether they will make money. So what happens is they are making a really zero dividend because they're not sure about how much money they will make in the next year. So they are not paying any dividend. So we'll look at the next statements. We look at their balance sheet. The balance sheet has a reserve of 2000 and now it has gone to minus 9,800. That is really bad. Their borrowing was 6,000. Their borrowing has now gone to 5,200. But in between you can see it has really gone up, up. Okay, it's just now falling. Again, it's gone up. So it's not a good kind of a borrowing company. They're borrowing, they're paying. They're not such a good company. And their investment in assets, it's 3,000 here. It's gone up, but over a period they are only selling their assets. They're selling their assets, selling their assets. They keep on selling their assets. So if you want to analyze this company in terms of financial, investment and dividend, and are they issued equity shares? Yes, they have issued equity shares here. See, this company is borrowing a lot, so financially they are not doing good things. Investment, they have bought assets and they are also selling, so that's also a bad sign. Dividend, they have not at all declared it, so again that's bad. Financial management wise, this company is a really bad company to invest in. So we look at their share price. Look at the share price, it was 1200 rupees. Okay, in 2006, and by 2019 it has come to nearby, I think it's 10 rupees or something. We'll put it as 10. From 1200 the company has gone to 10 rupees. It means it's a substantial value destroying company. Why it is so? Because the company has not been in a good financial management handling, and that is because of the mostly the industry. Most airline industries in India always suffer, and Airways is not a exclusion. So we have seen two examples: the relationship between the financial investment and dividend decisions. Okay, which is applicable to a good company and also to a bad company. So why should you know this? Because in a discursive kind of a question or in a theory question, you should be able to relate things and then write. Okay, the more and more practical your answer is, you'll score some good marks. Okay, just you write any very bookish things, you'll get marks, but still it's really good to understand how the things work in the real world. So we'll start with financial planning. So what does a financial manager do? See, financial manager is the person who ensures that the company always has finance over in the short term and also in the long term. So he is the person who plans to ensure that the company has enough funding, okay, at the right time to meet the needs of the organization for both the short term, medium term and also for the long term capital. So he has to decide the source of it, the timing of it, the cost of it, and which source of finance that has to be raised. So it is a very crucial decision. In the short term, it helps the working capital requirements, like how much of working capital you can have in a company. In the long term, it helps in purchasing a machine or constructing a new factory, and which form of equity or debit to be raised. All these considerations comes into play. So financial planning is planning which how much of finance to be raised, through which source it has to be raised, okay, and the appropriate time to raise it. So that is what financial planning is. To do this properly, they should have a financial control. What is financial control is? Financial control is certain limitations within which the financial manager has to act. So he has to raise equity or debt based upon their objective. That is, debit equity ratio should not be more than like 1 times. Then assume that the company is already having 2 times as debit equity, that means debit by equity is already 2 times, means the company cannot go again for debt. The company should go for equity. Okay, so that is about the debit equity. So the company has to establish objectives like these. One is debit equity, other one can be like ROC. The company has to have an ROC of 20%. Okay, the company should have an interest coverage ratio of 5 times. So uh, these are like objectives which are set to the financial manager. He has to work accordingly to these parameters, and he has to raise finance and invest in projects, and he has to manage the financial part of the company. So he then also adjusts it according to the reality. So assume that the equity market is like very poor in a particular year, then he can't achieve 2x. Okay, he can't go for equity, then he has to modify it into 2.5x is okay. Then he has to go for debt, because equity cannot be raised in a particular year, means he has to go for debt. Okay, so just because 2x is there and the company has to fix around 2x means, and in reality certain factors have changed, like equity market is not supporting, or investors are not willing to give their money to the company. In those certain terms, the objectives has to be changed, and control can also be established through ratio analysis. So these are also again ratio analysis. Okay, so financial planning and financial control are both simultaneous elements here. So that's how it works. We'll see the relationship between strategy and financial objectives. Okay, see, this is the overview of a strategy process. The company starts with its mission objectives, it creates a SWOT, then it finds out to achieve the mission and objective, what are the various options it has, then it evaluates which is the right option, they implement their objective, periodically they check whether that strategy is working or not, and finally they keep evaluating it. Okay, so where does a financial manager come here? See, the financial manager is the person who fixes the objectives for the company, like what should be the ROC, what can be ideally the ROC, what can be the debit equity ratio for the company. These are the things. Then he evaluates the investment decisions. Assume CEO says 3 4 investment opportunities to build a factory, to export, or to import something. Financial manager evaluates the decisions such as which project to invest. Okay, and how this will affect the dividend policy of the company, and what is the source of finance for this decision. Okay, so he thinks in terms of these decisions. Even though this entire strategy is taken care by of the CEO, the financial manager has to support the CEO in terms of financial ideas. Okay, so he will also consider whether the project which are like suggested by the CEO is okay or not. Okay, so he will tell his part of the view. So finance is not something which is separate from the strategy, it's part of the strategy. This will help you in answering questions at the SBL paper. So what are the financial objectives of a company? So usually these are the objectives: profit maximization, wealth maximization, gearing ratio, profit retention, and operating profitability or profitability ratios. We'll start from profit maximization. So the objective of an organization is to maximize profit. That's a nice thing. Profit maximizing is about increasing the profit of a company. How do we know whether the company has increased their profit? It can be measured through EPS, earnings per share. This is a nice concept when the owner and the manager are same person. Okay, if not, then profit maximization is not a good technique. Why? Because profit maximization is a technique where the profit can be manipulated by the manager and submitted to the owner. Okay, so the manager can cheat or manipulate the EPS. Okay, and after manipulating the EPS, he might give it to the owner. So over a period of time, what happens is the manager keeps on manipulating the EPS, and the owner believes that the EPS number is to be true. So profit maximization is not a good idea at a corporate level. So profits can be manipulated. So profit maximization is not such a good method to track uh, shareholders' wealth. Thus, profit maximization is a flawed financial objective. So we'll move on to the wealth maximization. The objective of an organization is to maximize wealth. Maximizing wealth maximization is about increasing the value of the company, not the profit of the company. But the question arises, what is the value? What is the value that we are going to increase? Value can be book value. Book value can be net assets. This you will learn in detail in business valuation chapter. But in terms of to understand now, book value is the stated value in your balance sheet. So book value is the balance sheet value. Usually balance sheet values are historical values. Okay, they are not real today's value. Or you can measure the wealth of a company or the value of a company through market value. What's market value? Through market capitalization you can measure it. So multiply the total number of shares of a company into the current market price of the share, you will get the market capitalization. With that you can find out the wealth of a company. Wealth maximization can also be liquidation value, the value that is realized by selling all the assets. Of course, companies are not trying to sell their assets. And there are other ways to measure wealth maximization. So one formula is a very important formula from your exam point of view is total shareholders return. That is the price after 1 year, the price of today plus the dividend that you'll get within this year divided by the price at which you have bought. Assume that you have bought a share. Okay, you have bought a share. The price of that share is 100 rupees. Okay, that is P0. The share price has become 120 rupees in a 1 year time, plus you got a dividend of 10 rupees. So total comes to 30 rupees divided by 100. So that gives you 0.3 or 30% profit. Okay, so that is called as shareholders return. We can also measure the company's wealth maximization through total shareholders return also. So we'll have a quiz. You can read it by yourself. You can pause the video and see it. So we'll discuss which of the following statements are correct. Maximizing market share is an example of financial objective. No, market share is something which is related to the concept of marketing. Okay, market share is related to marketing. This is not correct. Shareholder wealth maximization is a primary financial objective of a listed company. Yes, financial objectives should be quantitative so that their achievements can be measured. Really good. Okay, for example, ROCE should be how much we want to achieve. 20% ROCE. This is quantified. So the answer should be 2 and 3 are correct. The answer should be C. So we got the answer. This is a 2-mark question. We have another question. You can pause the video. Which of the following is a sign that a company is failing to maximize shareholder wealth? The key element here is the word failing. Which of the following is not maximizing shareholder wealth? Management has a challenging performance bonuses. If the bonus is given for challenging work, it maximizes the shareholder wealth. So this should not be the answer. Investment decisions are evaluated on the basis of NPV. Further, if we read on other chapters, you will find out that NPV is a best method to evaluate investment decisions. So this is a good, this is increases the value of the company. So we'll strike off that. The company has not diversified its operations. Diversifying your operations and maximizing shareholder wealth doesn't have any relationship at all. So that's not answer. Financing of the company is done by equity finance alone. Usually financing has to be done with debit plus equity. Okay, because debt is very cheap and equity is very costly. So you have to do with both if possible. So the answer should be D. The answer is D. So which is failing to maximize shareholder wealth is D. So we'll discuss in this slide about the various stakeholders and their financial objectives. So here we have internal stakeholder, connected, and external stakeholder. With an internal, we have employee. Employees want salary. Managers want bonus and salary. Directors want salary, bonus, and ESOP. Shareholders want share price, profit growth, and dividends. Debt holders want interest and principal. Suppliers want prompt payment of bills. Government wants their tax and following their regulations. So this is where the financial manager has to play uh, a kind of a role where he wants to satisfy all the stakeholders and still make everyone happy. So here we'll discuss about corporate governance. So corporate governance is a system by which the company are directed and controlled by senior officers. So we don't need to think a lot about corporate governance. Okay, we have to think in terms of how finance and corporate governance are linked. Okay, so that is our element here. So we'll just look at here. See, if you're a small business owner, if you're a small business owner, okay, you own the company plus you manage the company. If you are a part of a company, okay, you are a shareholder. The shareholder is the owner of the company and there is a CEO. The CEO is a manager of the company. Okay, both these people are different people. Now the problem is like this. As you are the owner and manager in a small company, you won't cheat. But in a company, the shareholder and CEO are different people. The owner and manager are a different set of people. Will the manager cheat the owner? The answer is yes. Okay. So that is where the corporate governance issues start, because the owner is a separate person and the manager is a separate person, and the owner does not come to the company and check the affairs of the company on a daily basis. Okay, so there's a more chance for the manager to cheat the owner. So this is called as the agency concept. Okay, so if you take, an agent is a person who does the job of another person. So there is a owner and there is a CEO. The owner is the principal and the CEO is an agent. Okay, the owner appoints a CEO to manage the company and the CEO cheats. Okay, now you have two choices. To reduce the cheating, you have two options. One, allow him to cheat. Allow to cheat. Okay, that's one option. Or discourage from cheating. You have two options. Okay, allow him to cheat or discourage him from cheating. But either of it you choose, whether you allow him to cheat or you discourage him from cheating, you incur a cost. So that cost is called as agency cost. Okay, so to prevent the agent from cheating the company, okay, what the shareholders can do is they can give him more financial incentives. We can pay more bonus to him, so that we can say that don't cheat, we pay you more bonus, be happy with that. We can also give him shares, so he partly becomes a shareholder of the company. So his incentive to cheat the company becomes less, because he is also partly a owner of the company. We also pay him a bonus, but all these kinds of bonus, this free shares being given, all these are a cost. This is called as the agency cost. Okay, so in real world they feel that it is usually these kinds of cost, okay, is much more lower than allowing him to cheat. So the cheating cost, if he cheats, that cost is very higher. to discourage him from cheating. That cost is lower. Which is better? They feel that let's give him a lot of incentives so that he is not very motivated to cheat the company. Okay, so that's what agency cost is. So we have to give him a very good remuneration. Okay, so remuneration can be like this. It can be a performance related pay, something which is related to profit of sales. It can be rewarding the managers with shares. We can give him free shares, or we can give him ESOP, executive stock option plan. We'll have a question here. You can go through this question by yourself. Which of the following are not usually considered to be agency cost? Okay, costs associated with giving shares. Now only we found out that it's a cost. So this is a cost, but we have to find out which of the following is not a agency cost, right? So this is a agency cost. Cost of monitoring managers. We have to monitor them. So that is again a cost. The cost of obtaining a listing on the stock exchange. Listing on a stock exchange is not monitoring him or like benefiting him. So that is not an agency cost. Cost of divergent behavior by managers. If we don't give him benefits, he will cheat us. So that is a cheating cost. So A, B and D are related to agency cost. C is not a agency cost. Let's see the answer. The answer is C. Okay, so that's about this question. We'll move on to the next question. Which of the following is least likely to solve the agency problem between a shareholder and manager? So which will not help to solve the agency problem? Giving managers profit related rewards. This will solve the problem. Using external auditors to gauge company performance. If we engage an auditor, he will come and verify, and that can solve the agency problem. Writing restrictive covenants into bond contracts. Bond contracts is related to debenture holders or bond holders. That will not in any way affect the agency cost or agency problem. So this will not affect. Monitoring managers. If we monitor managers, they won't cheat a lot. So that is also a kind of an agency problem. So C is not at all related to the question. So C should be the answer. So that's about the second question. We will move on to the next part. We'll discuss about what is ESOP or executive stock option plan. So assume that you work as a CEO in a company. The company gives you a right to buy a share, a certain amount of company's share at a predetermined price for a specified period. So nicely memorize this statement. Okay, so that's about the ESOP. We'll see also an example how ESOP works. So assume that you're a manager, and the option agreement allows that the manager can purchase 500 shares of a company. He can purchase at a 50 rupees per share after 2 years. So whatever the price is, he can buy at 50. So once we give an ESOP, and the manager puts all his efforts to make the company great, and finally the company raises its share price to 70 rupees in the 2 years time. So now the manager will exercise his option. So what he will do, as promised, the company will give him 500 shares. He will pay 50 rupees for each share. So that will be 25,000. He can sell that share in the market at 70 rupees per share. So per share he will make a profit of 20, and he will totally make 20 into 500, $10,000 as his profit. So that's what here it works. 20 is per share gain and 10,000 is the total gain. So that's how ESOPs work. Okay, so they give you a promise, the company gives you a promise that in the future they will give you a share at a particular price. So as a employee in the company, your job is to put all your efforts and boost the share price and make it higher. So very nicely it works. But what are the good things about this? It acts as an incentive for hard work. You will work hard. It helps really in attracting and retaining talented people in the company. Employees are very clear like what they have to achieve. Their very single objective is to boost the share price and do things which improve the share price. All the efforts goes towards the goal of achieving the share price increase. It helps in continuous improvement. Employees look at the long term interest of the company because they have to increase the share price in 2 years or 3 years time. So they don't do things which are helpful in the 3 year, 3 month time, 6 month time. They focus on the longer term of the horizon. But ESOP is very good, but it also comes with its own set of problems. So problem number one is decisions that are contrary to the benefit of the organizations might be taken. Okay, so it's not that ESOP is there, they will, all the employees will be like working really for the benefit of the company. Still they might not work for the benefit of the company. ESOPs are usually for 3 years, 5 years period, so the longer time period actually does not motivate the employees a lot. There is no single metric to assess the company's performance. We say that the share price increase is good, but what if these CEOs and managers are manipulating the share price? So that can be the problem. To solve one problem, we have actually created another problem. There are factors which are outside the control of the employees. So assume that they have done a really good job. In the 3 years time, the share price is going up, but on the third year, there's a recession and the share price goes down. So the employees will be really demotivated there. It might encourage employees to manipulate the share price. So that is a very, very bad problem with ESOPs. So in this slide, we'll be discussing about not-for-profit. See, so what is a not-for-profit? See, not-for-profit organizations, for them, the primary goal is not to make profits. Okay, it's not, you can't measure them through economic measures. So if you can't measure them through profit or maximization of wealth or share price, then it becomes very difficult to find out how they perform. So NFP organizations have the following characteristics. Most do not have an external stakeholder. There are no shareholders as such, and hence maximization of shareholder wealth is not the primary objective. There are no shareholders, then what is the primary objective? So no profit maximization, no shareholder maximization. There is no need to distribute dividends. So financial management is concerned about financing element, investing element, and dividend element. There's no dividend at all in NFP organizations. Their objectives are usually some kind of a social, cultural, philanthropic kind of a activity. Hence, there is no profit element to measure at all in NFPs. When assessing the performance of NFP, it is important to include both financial and non-financial measures. So we can't have profit alone to be measured. We have to also measure some other non-financial measures. So that's where the difficulty arises. So what are the problems in financial management of an NFP? One, we cannot quantify the cost and benefit. For example, if you're running an hospital, you can't quantify the benefit of treating a patient having a cold and a patient having an open heart surgery. That benefit cannot be like measured very equally. That is very tough, and sometimes costs cannot be measured properly. For example, having police force is a cost. So can we cut down the police force? That is a cost. We can have cut down the cost by reducing the number of police employees in police force, but that would have repercussions in the number of crimes increasing. So there is a problem in quantifying the cost and benefit. Assessing the use of funds, which is the optimum utilization of the fund. Assume that in the case of police department, the money be spent on giving more salary to the police, give more salary, or give or install more cameras. Which has to be done? If you do this, the employees are motivated. If you do this, the crime gets reduced. Which one you have to do? That again cannot be measured because there is no ROCE as such, because motivation is non-financial. Installing cameras, it's partly financial, but the benefit it offers is non-financial. There are multiple and diverse objectives. So for police, it's about preventing crimes, ensuring safety, and building confidence among the people. So they have multiple objectives, so it's very difficult to trade one thing with another. The impact of politics on performance measurement, what has to be measured. Okay, so that again is a problem. So there are multiple problems in NFPs. So the best way to deal with this is value for money concept. So value for money concept is often quoted as an objective in NFP organizations, that is, have they gained the best value from the limited funds. Okay, again the word value is subjective still, but we only have VFM as the closest measurement technique for NFPs. So we use 3 E's. The first E is economy. So assume that we'll take a hospital. Okay, economy is we want to construct a hospital. Are we doing it at the lowest cost possible but at the reasonable quality, cheapest possible at the quality desired? So is the hospital of good quality and done at a lowest price? That is called as economy. Efficiency, here we link the input and outputs. Is the maximum output being achieved from the resource? So assume the hospital has been built to treat 100 patients. Okay, are we doing it? If you're treating 90 people, then it's 90% efficiency. If you are treating 120 people, it's like 120% efficiency. So we link between the with the construction of hospital, how many people we are trying to treat. And the last one is effectiveness. Effectiveness looks at not at the number of people being treated, but whether the hospital has finally achieved its objective. What is its ultimate objective? To reduce the total number of infections and patients in that area, and to increase their happiness of using the hospital service. So that's what is called as effectiveness. So NFPs can be measured in the following ways. So you can read it for yourself. All these NFPs are created for a university or a college, so you can read it by your own. We'll have this question: which of the following statements are correct? You can read it. Share option schemes always reward good performance by managers. The answer is no, it cannot always do it, because sometimes the share price can go lower. So this is not the right one. Performance related pay can encourage dysfunctional behavior. Yes. Value for money as an objective is in not-for-profit organizations requires the pursuit of economy, efficiency, and effectiveness. The answer is yes. So 2 and 3 are correct. 2 and 3 comes under C. Okay. So share option schemes always reward good payment performances. No, they don't always do it, because sometimes even when you give share options, people can cheat and the share price can go up or low, and it might not reward their performance properly. So that was the disadvantage there. So that's about this question. So these are the questions that have been asked previously in ACCA exams. Pause the video and just go through these questions. You will get a good idea like what are the type of questions they ask you. These are the last two questions that I have asked. So with this, we have come to the end. Thank you for watching. We'll meet in the next video.